Okay, today we are going to look at accounting equation. So this accounting equation is based on the business entity concept that business is separate entity from the owner of that business. This means that accounting equation is trying to show us that the business is separate from the owner of that business. Situation whereby you set up a business and you now put money into that business. So you as the owner of that business is separate from that business. So that money that you put in into that business is a liability to that business. So that is what accounting equation is trying to explain. And the first accounting equation is that we have a asset equals to equity plus liability. So this is once you want to calculate your asset, it has to be equity plus liability. And in accounting equation, asset must be equal to liability. That is what the accounting equation is saying. Okay, let's look at an example. Let's say George set up a business and put some capital into that business. Now, if you look at this, the business is different from George. The accounting system of the business was consider George as a separate entity, while the business that Mr. George set up is a different entity. So that is what this accounting equation is trying to explain. Let's now look at an example whereby setting up a business by introducing capital. Let's say capital. This is whereby you set up a business and you introduce capital into that business. Let's say Mr. X has decided to set up a business selling football shirts and in the market. So let's assume that he begins by putting 30,000 naira. Let's say Mr. X set up a business and he calls that his business, let's say X Ventures. That is the name of the business, X Ventures. And he now puts in 30,000 naira into that business as capital to the bank. So now, when we now want to do the accounting equations of this, and we said asset equals to liability. In this case, what is our asset? The cash of that 30,000 naira. 30,000 naira. This is our asset equals to what? Equals to capital. That is the equity, which is 30,000. Then plus what? Plus liability, which is 0. So you see asset equals to liability is what this is trying to explain to us. Then we can now look at another angle of a business whereby the same Mr. X, sorry, the same business that he set up, he now decide to borrow money from his brother to purchase it's a motor vehicle, and that motor vehicle will be used in that business. Then this our equation will now have to change. That motor vehicle to us, that is to the business, is an asset. Then the second equation now have asset. We already have 30,000 as our asset, and we have capital, which is 30,000, right? Then the money Mr. X borrowed from his brother, which is, let's say, 40,000 naira. So this 40,000 naira, what did we do with this 40,000 naira? We bought motor vehicle which is also an asset, 40,000. So now if we add this, what do you have? We have 70,000 naira. So this plus this is still 70,000 naira. So this is accounting equation. Then there is another one which we can say is buying an asset for cash. Buying an asset for cash. So now let's assume that the same Mr. X, he now use 5,000 naira to buy an asset. So how are we going to do it? Use cash to buy an asset. Initially we had what? 30,000 cost to 30 plus 40. Then we now do what? We now buy motor vehicle of 40,000. Bought motor vehicle of 40,000, which make it how much? 70 in our previous example, and this plus this we also have 70. So now we now bought assets with cash, which is 5,000 naira. Remember, this is our cash. So the new equation now will now be 25,000, because we have to remove 5,000 naira from this 30,000, and we now bring that we bought assets 40. So it's still 70. So we still have 70 here. Nothing will happen to this. Nothing will happen to this side. So we still maintain our 70. So this is the accounting equation. Thank you so much.